as well. So I think things are a little bit later this year, partly because Easter is earlier. But anyway, that's it. So what I want to talk about now is a new topic. I haven't taught this before, but it's something that's quite interesting, I think. The reason I'm doing this is I wrote a report last year. There's a thing called the Treasury Select Committee at the House of Commons, and every now and again they look at British monetary policy. So Mark Carney comes along and they interview him and stuff, and all that sort of stuff. So I was preparing that and for it, and normally when you submit something to the committee like that, it's normally published. In fact, but because of the election, Theresa May called a snap election last year. So I didn't. It was never actually, although I wrote it, it was never actually discussed or presented. So I thought I'd make some use of it. So this is basically based on that report, which was stillborn, but I think it's quite an interesting thing. So British monetary policy. I'm going to look at monetary policy in the age of financial repression. Who borrows wins. I like who borrows wins. So and it basically involves people getting squeezed, as you'll see. So the notion of financial repression and applying that phrase to British monetary policy has been sort of off and on. You'll never hear Mark Carney mention it or anybody from the Bank of England, and it's not a phrase which is used very much. But it has been used by Carmen Reinhart and Ken Rogoff. So I've got a little quote from there. And they did a paper which was basically saying that financial repression is basically something which is going to be necessary to return governments to sustainable levels of debt. And that was covered by Larry Elliott. There are some earlier instances of the use of the term. And in fact, I first used the term in 2011. I was giving a talk to the UCL Finance and Economics Students Group, and it just suddenly it occurred to me that it was an appropriate phrase to use at that time. What do we mean by financial repression? Well, in this context, what it means is negative or very low real interest rates. I mean, they're negative at the moment. There are other features. The phrase financial repression was actually first coined to look at the developed world, where you had repressive or authoritarian regimes which would borrow money from their populace at negative rates. And there were other possible features which you might have with financial repression. For example, control of currency and foreign exchange, compulsory purchase of government debt by pension funds and stuff, not allowing people to take money out of the country, all that sort of thing. So there are extreme forms of financial repression, and I'm not suggesting that we're living through that, but certainly this feature of it, of negative or low, very low real interest rates, is a feature. If we go back to the Fisher equation, what do we mean by the real rate of interest? Well, it's the nominal rate. That's the rate that you see in the newspapers, 0.5% at the moment, the Bank of England policy rate, or whatever the loan rates are for mortgages and other things, minus expected inflation. So that's the basic equation for the real interest rate. It's a difference, if you like, between the expected nominal rate of return over a given period and inflation over the same period. For government bonds, how can we think? There are different ways of calculating it. I'm going to approximate it by a very simple way, which is to look at the bank policy rate minus the headline inflation rate. Now, the headline inflation rate, the actual rate of inflation that's reported, is of course a backward-looking measure. It's looking at how much inflation there has been in the last 12 months. It's not a forward-looking measure saying how much inflation there's going to be. So it's a sort of approximate. It's a sort of rough rule of thumb, but it's not the best measure. I'm just using it here because it's simple. But if I wanted to do anything fancy, econometrics or anything like that, then I'd need to use a slightly better measure of the real rate of return or expected real rate of return. But if we think of I don't really think it matters too much, because if we think that people have rational expectations, some people like that in this sort of place, well, that means that we can look at the actual, when we're looking at things historically, we can look back at the actual real rate 3 months or 6 months or a year ahead, and we can use that as our measure of the real interest rate. So it just sort of moves things around a little bit. What do we get if we do that? Well, here I'm looking at the real and nominal interest rates using the RPI inflation measure. So we're looking over 60, nearly 70 years of history here, from the Second World War to the current period. And we can see that we've got the real rate is the blue line at the bottom. We've got inflation is the red dotted line, and the green line is the nominal interest rate, the Bank of England policy rate, which you can think of as a short-term interest rate. So if we look here, we can see that there have been periods when you've had negative real interest rates, the nominal rates being below the rate of inflation. There are two main ones historically before. One is the 1970s, when inflation got very, very high. You can see there that inflation was above 20% briefly in 1975. So we had this big inflationary episode. Many Western economies had inflationary episodes like this, but we were amongst the worst ones, in the sense that our inflation rate reached quite high levels. So nominal interest rates didn't really keep up with inflation, as we can see there. They did eventually, but there were periods when we had these short periods when we had these negative real interest rates. The other period was way back in time, which was in the early 1950s, when there was quite a lot of inflation, and that's associated with the Korean War and the immediate aftermath of the Second World War. So we had a lot of debt in that period, and so we had a bit of negative inflation rate, negative real interest rates there. But if we look in the more recent, now you might say the 70s was a bit of absent-mindedness. People didn't really understand what was going on then. We hadn't really had inflation at that level for a very long time. You've got to look back to the end of the First World War or times like that to have high inflation. So it was a new phenomenon, inflation, and people didn't really understand exactly what was going on. So you can sort of say that, yes, we had negative real interest rates, but it wasn't because people knew it was going to happen and understood it well and planned it to happen. It just sort of happened because it was a bit crazy. Inflation just got out of control, and it was difficult for governments to raise interest rates for political reasons. Interest rates drive mortgage repayment rates, and people don't like having mortgage repayment rates of 10 or 15%. It's quite high. So there was a lot of political. It was difficult for governments to raise interest rates, to levels of 20% when inflation was going at 20%. So they didn't do it. So I don't think you can say that was a plan. But what's happened in more recent times, you can say, well, it is sort of planned, really, because one of the main reasons why you've got the negative real interest rates isn't because inflation's crazily out of hand. I mean, it's quite high. This is the crash here. And just before the crash, inflation was more or less 5%, which is quite high, above the Bank of England's target rate. And just after, it was also 5%. It was above the Bank of England's target rate. But the Bank of England chose not to do anything about it. So we had a first period of financial repression, if you like. And I can just explain a little bit more what happened. So since the 1980s, anyway, we've had positive real interest rates throughout the whole period. And but with the recession in 2007-8, we're in a period where a sustained period of negative real interest rates, which we can think of as an age of financial repression. So we can look in a little bit more detail. So what I've done is I've just looked at from the 90s. I've sort of that's the long view, and I'm looking at CPI inflation here. So CPI inflation. What's the difference between RPI and CPI? Not much. RPI tends to be a bit bigger for various reasons. But CPI is just a slightly different method of calculating inflation. It tends to be a little bit lower. It's what's used in the European Union. The harmonised HICP is what it's called, to give it its full name. And it's only been calculated back for Britain, back to the late 90s. Nobody's got an official measure going back later than that. So this is the ONS official measure of CPI, which goes back there. So we can see there, we've got the phenomenon, we've got the real interest rates there. So we've got the same things there, but they've got different colours, I'm afraid. The real interest rate's now red. Nominal is the dark line, and the dotted line is inflation. So interest rates have been constant more or less all this time. They did go down briefly as a result of Brexit, after Brexit, and then they're back up again. So the real interest rate is really just the mirror image of the inflation rate in this period. So we can actually say that there's been three sorts of let's look at monetary policy in recent times. So we can contrast. So we've got this age of financial repression we've had since 2007. What was happening in normal times before that? Well, if we looked at the period, from the mid '90s, early '90s, right up to 2008, 2007, we can call that as fairly normal times. So during this period, real interest rates rose positive. They were in the range 2 to 5%. Okay, inflation was on target, in the range 1 to 3%, nearly all of the time. There were some times when it was a little bit higher, a little bit lower. And the nominal interest rate was moving around. So it had a high level of 7.5% in 1998, and it had a low of 3.5% in July 2003. So you can see that there. That's the nominal interest rate there. That's its peak there at 7.5%, and it had a low somewhere here at 3.5%. So that's it. So we can think of this as normal active monetary policy. It's what I talked about in the first lecture. So all the literature on monetary policy, the Barrow and Gordon approach that I outlined in my first lecture back in at the end of January, early February, that had been written in the 1980s. It was well understood, and central banks were sort of implementing this sort of policy. You've got an inflation target. When inflation gets a bit high, you raise your nominal interest rates to keep them above the inflation rate. And this is what the Bank of England was doing. It wasn't made formally independent until 1997, but once we were thrown out of the exchange rate mechanism on Black Monday in 1992, I think it was, so we were all set to join the euro, but things intervened, and we were thrown out of the exchange rate mechanism. And after that, the Bank of England, rather than shadowing the Deutschmark, which it had been doing before for a few years, it switched to having an inflation target, and it was made fully independent in 1997. So formally, the Treasury was still in the hand, but in practice, it was leaving it to the Bank of England in the mid-90s. So we can understand then the monetary policy in this period in terms of the Barrow-Gordon model, topic 1. And it was quite successful. If you look at that, it's in terms of the Great Moderation. Both output and inflation are stable over this period. There was a bit of a debate about whether this was due to monetary policy or it was due to the effect of China coming along and giving us access to relatively cheap goods and so on. But certainly there's a good argument saying that monetary policy had a role to play and kept inflation in check in a way that it hadn't done in the 1970s, for example. And we can also think of the monetary policy in terms of a Taylor rule, the interest rate responding to inflation and the output gap. This sort of model, as I showed you a couple of examples, it doesn't really perform very well, the Taylor rule, for the UK. It performs a lot better for the US. That's probably because we're an open economy and there are other factors going on. But that's it. But then we have a transition. So the crisis came along, output fell, but we got this transition period. When nominal interest rates were still high and inflation was rising. And because inflation was rising, the real rate fell. So you can see that in terms of this diagram here. The dotted line, the blue line, is shooting up there. The real rate is still quite high there, but the inflation is rising, so the nominal rate is falling quite rapidly. So the fall in output doesn't really happen. The fall in output doesn't really happen until 2008. So I haven't mapped that there, but there you go. So that's, if you like, a transition. But then what happens? Well, everybody started to get worrying about deflation. So as output started falling in 2008, people started worrying about the effect of deflation. Deflation meaning negative inflation. So we sort of moved from a situation where inflation was very high, it started falling. And that meant, I've got a quote from the Daily Telegraph, you can find it, there are lots of things, people writing about this. So that's from the Daily Telegraph, the 5th of December 2008. Interest rate cuts, deflation harms everybody. People were very worried about deflation. Now you might think, why are people so worried about deflation? We have had a period of zero inflation quite recently. If you remember a couple of years ago, inflation was zero. I don't know if you were looking at the news at the time, but we had a year, it was 2015 more or less, when inflation was more or less zero over that year, and the world didn't fall apart. But anyway, but certainly people were worried about falling prices. If prices are falling, it means the value of debt. If you owe people money and prices are falling, the value of that money is going up. Apparently, this is something that harms everyone. I don't think it really harms everybody. It depends whether you're a lender or a borrower. But certainly that was what was said in the press, that they wanted to avoid deflation. So you then saw the Bank of England cutting interest rates fairly precipitously from 5% in June 2008 to 0.5% in 2009. And that's where they remained until after the Brexit referendum, when they were cut to 0.25% and then they've just recently been put up. Deflation never appeared. It depends a little bit whether you measure RPI and CPI. One of the differences between RPI and CPI is that RPI includes the cost of owner-occupied housing, and because house prices fell, the RPI actually did become a little bit negative very briefly. CPI did fall, but it didn't actually become negative. The blue line there stayed above zero. There's the period when the dotted line is actually around zero, and it bottomed out. So it bottomed out. So what happened to CPI? It bottomed out at 1.1%. It fell at the end of 2009. But it went up again. Inflation went up to over 5% in 2011, which is sort of when I gave that paper in UCL I told you about. And so to me then it's look, well, you've got an interest rate at 0.5% and inflation's at 5.2%. This is financial repression, and it has quite observable effects, which I'll show to you a little bit later in a lecture. Now, what was the cause of the inflation? Well, we had a double devaluation. The pound fell 20% against both the dollar and the euro. So I think it fell against both. Sometimes the pound goes up and down all the time against the dollar and the euro and so on. It rarely goes down against both. And when it does, that can be quite inflationary, because a lot of commodities are denominated in dollars, like oil and so on and so forth. Plus, our main trading partner is the Eurozone, so obviously the euro affects us. So if the pound goes down against both the dollar and the euro, we get all sorts of cost shocks. Things cost more, and that tends to generate quite a lot of inflation, as we've just seen. So from 2009 onwards, basically, we enter into a period of financial repression. And because interest rates are constant at approximately zero, to look at the real interest rate, we simply need to look at CPI inflation. I say we can think of this as a backward-looking measure of the real interest rate. If you want to put it forward, you could just move the line forward, move the dates around, because you could be looking at the actual rate of inflation 6 months ahead as a reasonable representation of the expectation of inflation, if you have rational expectations. So we can think of 3 periods. The period 1 was up to 2013. There we are. That's this bit. So this is pre-crisis. This is the crisis hits. Inflation falls. Then it goes up. So that's if you like, the first period of financial repression, which lasts along here for a few years, 4 or 5 years. This is under Mervyn King. Then we have a period of it ending. Inflation comes down, goes to zero for a period. That's financial repression ends and inflation falls to zero. So the real interest rate then was more or less zero or slightly positive. And in fact, if you were a saver, inflation in that year, 2015, was zero, and you were getting something like 2% on your savings if you had any savings. So you could say for savers, the real rate of interest was positive. Ditto, if you had a mortgage, your mortgage rate would be 3%, and that was more than inflation. So you can say, in a sense, that this year, 2015, things were pretty normal in terms of output was growing as well. But obviously, the one way in which it wasn't normal was that inflation was very, very low. So we haven't had many periods since 1935. Well, in fact, I know this because I looked at the data for another thing. So since 1935, inflation has never been negative, apart from the odd month here or there. And this is the only period where we had almost a year when inflation was more or less zero over that period. So that's quite so it's quite an exceptional period. But if you just look at things like economic growth, real interest rates, and so on, it's actually not too bad. But then we had the Brexit vote. Inflation started rising a little bit, but we had the Brexit vote, followed by Mark Carney's cut in interest rates, and he said interest rates are going to remain low for a very long time after the Brexit thing. And pound collapsed against the dollar and the euro yet again. People were again, I remember on TV, they were discussing the possibility of a $1 to the pound. The last time I remember them discussing that was back in the 1980s, when under Mrs. Thatcher they had a brief discussion of that. But of course it never happened, and it's gone. It's $1.40 now. But certainly this led to a big increase in inflation, and we're currently at the level where inflation is round about 3%. Now, this rise in inflation was perfectly foreseen. In fact, the Bank of England Quarterly Bulletin, they do an inflation forecast. So if you look at the inflation forecast when just after Brexit, when the Bank of England cut interest rates, they were predicting there would be a 2.8% inflation rate the next year in 2007, which was more or less correct. It was a little bit higher than 2.7, but within the bounds of forecasting error, it was forecast. So the Bank of England clearly knew exactly what was going to happen. We were going to have from a situation where the real interest rate is more or less zero, slightly positive, we were going to go back into a situation that we had before of financial repression. It was fully seen. Now, you can say that what happened before with Mervyn King, that was sort of foreseen. As I say, originally people were... there was a lot more uncertainty an economic crisis has just hit in 2008. There's panic. It hasn't happened for a long time. The worst crisis since the 1930s. And a couple of people who are very, very old, but not many people could remember the 1930s. But they could read about it, and they knew that something big needed to be done. So they weren't. Up until 2000, the end of 2009, people were more worried about the possibility of deflation in the future. So in that sense, you can say that the rise in inflation was actually not unanticipated. I mean, there are a range of forecasts, but certainly, even though it was, people got to know the inflation once it got underway, people knew it was happening, and the Bank of England didn't raise its interest rates. I think that was not unreasonable, because the crisis was still underway, output was still well below its 2007 peak, and it's sort of excusable, if you like, that they didn't raise interest rates. But they felt quite uncomfortable about it. The Deputy Governor of the Bank of England, a chap called Spencer Dale, came and gave a talk here. It was actually in the Julian Hodge Lecture Theatre, and he's actually a Cardiff alumni. He's an undergraduate in Cardiff, so he said he was feeling a bit nervous talking to some of his old lecturers. But he was a Deputy Governor, and he was saying, well, look, inflation is very high, but we're still committed to inflation targeting. He was trying to keep that line. I mean, it wasn't very plausible. I think what was happening was the Bank of England, were just hoping it was going to die away fairly quickly. But unfortunately, the increase in inflation was a bit more persistent than the bank had hoped, and lasted for a while. So I think the first period of financial repression, you can sort of understand. They didn't want to raise nominal interest rates straight after the crisis. They were still worried about house prices and lots of other things. And so they, rather than do that, they thought they'd err on the side of safety and keep things on a level keel. But this time it's rather different, because it was fully foreseen and, in my opinion, completely unnecessary thing to cut interest rates straight after Brexit. Brexit may be a bad thing in terms of economics. Well, it almost certainly is in terms of economics. But the effects of Brexit are in the future. Well, they were in the future in 2016, and there's absolutely no need to cut interest rates. And in fact, it was I think historically it'll be looked at as a great error, in much the same way that a lot of people say that the cut in interest rates after the Twin Towers were blown up in 9/11 by the American Fed was a great mistake. But that's another thing. Now, what do we mean by financial repression? How do we understand it? Well, in a world of perfectly flexible prices and perfect capital markets, inflation really wouldn't matter at all. So then, the nominal interest rate that you see would simply be equal to the equilibrium real interest rate plus inflation. Now, if you're a borrower or a lender, anticipated inflation wouldn't really matter. So if you're looking at it from as a borrower, there's two elements to your repayment. So suppose inflation is 10%, and the real interest rate is 5%, then the nominal interest rate will be 15%. So you're paying 15% on your mortgage. May sound rather high, but the first mortgage I had, it was 15%. It sounds rather high, but 5%, if you like, is the real interest rate part of it, and 10% is the inflation part of it. And so when you pay that 15%, what you're doing is you're reducing the real value of your debt by 10%, and you're paying interest on it on your debt of 5%. So if you want to neutralise the effect, so what inflation is making you do is pay your debt down more quickly. So when you have a 10%, a 15% mortgage rate, when there's a 10% inflation, essentially what you're doing is you're paying off 10% of your capital in that year. So let's just see what let's just look at an example. Suppose you have £100 of debt. Think of it as 100,000 or a million if you're thinking of a house. Okay, you've got 10% inflation, real interest rate 5%, normal interest rate 15%. So if you pay the full interest, after 1 year, your debt is only worth £90 in terms of year one prices. Your debt has gone down by 10%. So with that 15% interest rate, when you pay that 15% interest rate, it means that your debt goes down by 10%. Now, if you have perfect capital markets, so if you don't have perfect capital markets, what the inflation does is it forces you to pay off your mortgage more quickly. So if you had zero inflation and 5% real interest rate, the normal interest rate would be just 5%. And then you're only paying off the real part of your interest rate, the real bit. So inflation then is sort of making you pay back your debt more quickly. It's sometimes called front-end loading, is a phrase that people use. Now, if you have a perfect capital market, no problem. You can just issue more debt. So what you can do is you've got your £100 or £100,000 mortgage. You take out another 10% over the year. So at the end of the year, you've got £110,000 debt, which is worth exactly the same as it was before. And you use that 10% to pay off your interest payments. And you rarely only end up paying the real interest rate element, the 5%. So with the perfect capital markets, you can just issue more debt to keep the real level of your debt what it would be without the inflation. So that's a very important part. So with perfect capital markets, inflation needn't be a problem. And you can say that also if you're a lender, exactly the same thing. You just need to issue new debt to keep the real level of your debt constant. So for the government, the biggest lender in the land is the government. So what the government should be doing is it should be issuing new debt to cover the inflation part of the interest payments and just servicing the debt with the paying, if you like, out of taxpayers' money, the real interest rate part of it. So that's what you should be doing. The government should be doing it. Now, the government can quite easily do that if it wants to, but of course it's much more difficult for households to do that because there's quite a large cost. You can't just keep remortgaging your house every year. I mean, people do remortgage their houses, but it's a costly exercise, and you can only do it once every few years. So if there's a lot of inflation and interest rates are high, then that effectively means that homeowners are repaying their debt at a faster rate than because of the inflation, and the nominal value of their debt is going down. So that's what would normally happen. Okay, so as I say, with households, it's difficult for them to do that. Governments can do. Now, with unanticipated inflation, of course, the story is a little bit different because neither the borrower or the lender anticipated it, and so if there's a bit more inflation than was expected, the borrower wins because the real value of what they have to pay back is less. If inflation's a bit below what people thought it was going to be, the opposite is true. So unanticipated inflation redistributes money from borrowers. Unanticipated extra inflation redistributes money from lenders to borrowers. So if inflation is higher than was expected, the borrowers win out because the actual interest rate, what effectively unanticipated inflation will mean, the ex-post real interest rate is lower than what you expected it to be. So the Fisher equation, in terms of the Fisher equation, the ex-post real interest rate will be a little bit lower than what was that doing it. So that's it. But of course, you can't have unanticipated inflation all the time. You cannot fool all of the people all the time. I think to quote Milton Friedman. by their nature, by its very nature, unanticipated inflation is transitory. It's not going to last for ages. So, if you have rational expectations, it's just white noise. It's got a mean zero with no serial correlation. But even if you have adaptive expectations, it's not going to. You can't have unanticipated inflation all the time, unless you have something really crazy like going into hyperinflation or something, which leads to other problems. Now, I've just focused here. This isn't supposed to be about the general costs of inflation. Obviously, there are other elements to that argument. I'm really just focusing on this issue of financial repression and how money is redistributed between borrowers and lenders by inflation, and just really making the point that in a normally functioning market, or at least with a perfectly functioning market, with perfect capital markets, inflation shouldn't really make that much difference in terms of borrowers and lenders. If capital markets are imperfect and it's difficult to borrow more, to issue more debt, as in the case of mortgages, then the inflation will have an effect. In a sense, it means that the borrower is forced to pay down its debt faster than they would have done without the inflation. So what's financial repression? Where does that come into that? This completely changes the whole picture. If the real interest rate's reduced as inflation rises, then you get a completely different story. And I've just got a little table here which looks at that. So we've got table 2A, we've got zero inflation. So here we're looking over 10 years here. So these are just two tables actually. I could have combined them really, but they're there. So we look from year 1 to 10, year 0 to 10. So in table 2A, the price is constant, 1. So the deflator is just 1. The deflator is the opposite of the price. It's what you divide the. It's how you deflate the prices to express them in terms of prices in period 1. So because prices aren't changing, a pound now is exactly the same as a pound 10 years in the future. You deflate the price £10 in the future by 1. It's exactly the same. So suppose you have a pound of nominal debt, then that pound of nominal debt remains exactly the same over the years, and the real value of the debt is exactly the same. So here's a situation where there's zero inflation, and we could just assume that there's a zero real rate of interest as well. Now what happens if you have inflation? Well, it's rather different. Okay, here the price level is going up. Okay, it's going up all the time, about 10% there. Well, it is 10%, so it's going up at 10% inflation. Now here we have to deflate future prices, so a pound 1 year hence is only worth 91% of what it was in year 0. So these are deflators. This is what we've got to multiply future pounds by to get them back into the value that they were in year 1. So 10 years in the hence, 10 years from now, a pound will be worth only 39% of what it is now if we have 10% inflation. So we can look at the nominal debt is remaining constant, but the real value of your debt is falling all the time with the deflator. It's a very simple way of looking at it, but it is. So in this period, we can see how the value of the assets has changed in real terms. It's declined. And so this makes a big difference if you're a borrower or a lender. If you're a lender, if you've got money in the bank or you're lending it, then it's very bad news, because essentially the value of your asset is shrinking. The borrower, on the other hand, is having a great time, because inflation is just inflating away their debt. And in fact, you sometimes have this phrase, inflating away debt. And I hope I've made clear that if you had the same real interest rate, then that wouldn't it wouldn't work. But in equilibrium, inflation, it would alter the way that the schedule of payments to some extent, but it wouldn't make you better off. But with financial repression, that's not true. If you have a zero rate of interest, here you've got a zero rate of interest. Here, if the rate of interest was zero, you'd have a minus 10% real rate of interest. So if the nominal rate was zero, you'd have a minus 10% interest rate. And there's a clear redistribution of wealth that goes on there. And if we look at the period from 2008, we've been in exactly a situation like this. The nominal rate of interest has been almost zero. Okay, inflation hasn't been 10%, but it's been up to 5%. And it's clearly redistributed wealth from lenders to borrowers. Note that the financial repression is not due to low nominal interest rates. The unique thing about this period of financial repression is that we have both negative real interest rates and low nominal rates. If we go back to the 1970s, we had negative interest rates, but that was with the real interest rate of minus 10% was because the nominal rate was like 15% and inflation was 25%. So in the 70s we had high nominal rates. Just to remind you, I'll go back to that figure somewhere. 70s, yeah. So that the green line is so in the 70s we've got negative real interest rates, but we've got very high positive nominal rates. It's just that we end up with a negative real rate simply because inflation was so much higher. So that's it. So what are the effects of this on government financing? I say the government is the biggest borrower in this period, and it's also been a big gainer through this thing. Now I talk about the government. Obviously, the government is us in a sense. So if it's good news for the government, it's good news for us as taxpayers. But so I'm not. It's wrong to think of the government as its finances are very intimately linked with our own finances. But essentially, you need to adjust the deficit for the repayment due to inflation, and this is something that people haven't done. And this puzzles me a little bit, but I think there's a way to understand it. So in the 1970s, we had quite a lot of inflation, and people thought, well, how should we adjust for this in the way that we look at government accounts and even private firm accounts? Well, and there was this thing of inflation adjustments being made to magnitudes. And so the framework for doing that was developed. There were two economists at the Bank of England who did it for government finances, Threadgold and Taylor. I can't remember their first names, unfortunately. I have met them, but a long time ago. And it was also done for firms. Now, it never caught on. Inflation accounting never caught on for firms. The reason being that inflation accounting basically reduces profits. It makes them look smaller. So, guys who run firms don't like things that make their profits look smaller. So they didn't do that. So they always like to pretend their profits are bigger than they are, so they can get bigger bonuses and so on. So it never really caught on with firms. With governments, it did a little bit, inflation adjustment. But that was in the 70s, and because we've been living through a period of low inflation, when inflation's only 2 or 3%, it doesn't make much difference really. I think people just forgot about it, and indeed they still have forgotten about it. But you can actually look at the effect of inflation on the deficit. So if we look at Britain, this is the deficit. The left-hand side is as a percentage of GDP. So as I say, in 2009 we had a big deficit. We talked about that yesterday, and it's come down, and it's pretty much down to the blue line. It's down to it's below 3%. So we're sort of back to normal times now. It's come down even more than in this. Just the data I had only went up to this period. But we can adjust the deficit to take account of the fact that there's been a fall in the real value of the debt of the government because of inflation. And if we do, because in effect this inflation means the government is repaying some of its debt. in a sense, it's not actually repaying it. It's simply what it owes is going down. And you can subtract that off the deficit. And if you do that, you get the following figures. So there's 2011 when the inflation was 5%. There's made a huge difference there. That's 2015 when inflation was 0. They're exactly the same. But in most cases there is some quite significant difference. So things actually were better then than they looked. So the government was saying, well, look, we've got these huge deficits. Well, they were quite big deficits. But if you took account of the fact that the inflation was having on the value of what they owed, the deficits were a lot smaller. And that they should have taken that into account. And it's interesting, this inflation adjustment, the Office for Budget Responsibility, which is the body, they don't do inflation adjustment either, and they should be doing it. Roughly speaking, how do you make this inflation adjustment? Well, essentially, you've got your this bit here. You've got the deficit, the usual deficit, which is given by this, which is the difference between government expenditure, its income, plus its interest payments. Obviously, financial repression is reducing its interest payments because the interest rates are very low, so the R figure is relatively low, so that's tending to reduce them. But you have this additional factor, which is pi b, the fact, if you like, it's like seigniorage on the money supply, but it's extended to all government debt. So in the previous lecture, we talked about the effect of seigniorage, inflation reducing the value of money. Well, when you have financial repression, that effect is generalized right across all the debt. So it's not just money, but it's also the value of bonds. Because, the interest rates are artificially low, you've got inflation, and that's reducing the value of the government bonds. So that's why you have a plus there. Oh, I've got a plus there, haven't I? No, that should be a minus, actually. That should be a minus. Let me just have a think there. Minus RB. Yes, that should be a minus there. Sorry, that should be a minus. I only did these first time I've done this, so teething problem. Sorry about that. Probably leave it next year and say the same thing. But anyway, that's it. So that should be that should be that, and so that should be RB should be a plus. So those are both the wrong way around. Oh well, there you go. Because the interest payments are an expenditure, and the pi b is, if you like, a form of seigniorage or taxation. So in effect then, financial repression is a way of extracting seigniorage, not just from money, which doesn't have an interest rate, but on bonds. And the way you do that is by reducing the real rate of interest, by keeping the nominal rate of interest below the rate of inflation. So if interest rates had been at least equal to inflation, or higher, then the national debt would have been significantly bigger over this period. So it would have been bigger by essentially the cumulative value of all of these differences here. So it would have been quite significantly bigger if there hadn't been these inflation effects due to financial repression. So I mean, it's hard to say exactly what it would have been, but it's something like of the order of 10 to 12% bigger than it is now. How big is it now? Well, we talked a little bit about this last week, but it currently stands at 84.1% of GDP. So it would have been 10% bigger, maybe 90%, 94%, 95%. And indeed, if you that figure, the current figure in January, just the latest figure, it's 1.736.8 billion, 1.7 trillion pounds at the moment. That excludes the debt of the publicly owned banks. So you've got a whole load of money tied up in RBS, Royal Bank of Scotland, which is still likely to be sold at quite a significant loss. And if you add that on, it takes it up to just about 2 trillion. 2,000 billion, which is more or less just under 100% of GDP. So without the inflation, it'd be about 10 or 12% higher than that as well. So that's it. So there's our total public sector net debt. That's the bit. That's Royal Bank of Scotland. The figure that the ONS normally gives out is the figure that excludes the Royal Bank of Scotland stuff. So that's what's been happening to our net debt over time. It's sort of gone up, and there are the latest figures there. So this is the net debt. So it's 84, whatever it is. That's the 1.7. Okay, so now there are other interesting features of financial repression with low interest rates. One of these is cars. Okay, cars. Okay, financial repression, it does benefit some people if he or she who borrows wins. And one of the big effects in America and Britain has been personal contract purchase, PCPs. The car buyer, when you buy a car, you have a fixed monthly payment. You pay a fixed sum, and then you have a monthly payment for 3 years, or for some other period, it could be 4 years or whatever. And then at the end of that period, you have the option of either paying the balance that's owed on the car, or just returning the car if it's in reasonable condition. Now these have become really, really popular, and I was wondering, if you look in the last 10 years, the quality of cars, people are spending a lot of money on cars. You see all these big SUVs and cars that cost a fortune. And I'm an economist, so I never buy a new car. The idea of driving out of the garage and suddenly the car's worth £2,000. I can't do it. It's too painful. So I only buy second-hand cars. But you see all these flash new cars. How on earth can people afford them? What are they doing? Okay. Well, I then understood what it's all about. It's basically because of the low interest rates. What the car companies are doing, essentially, through their finance arrangements, is that they're borrowing money very cheaply at 1% or something, and then they're lending it to you so you can buy their car. And this makes quite a big difference. So that if you've got a £40,000 car, the annual interest rate on £40,000 is very little, 400 quid. So you can borrow for £40,000 effectively for almost nothing. So what that means is that when you buy that car through this arrangement, essentially all you're paying for is the depreciation of that car. Which is quite a bit, but you got a nice fancy car, a shiny car, so it feels good. So one of the places that's done it is this Chinese woman, Ling. I've forgotten the rest of her name, but she's a big player in this market, selling these things. And so you can buy BMW Series 5 2-litre diesel estate for £600 a month over four years. That's really cheap. And you can get a small car, Citroen C1, £150 per month. Now, why are they able to offer these great deals? It's because of this very low interest rate, and that your monthly payment is more or less just paying, plus the upfront payment, they're just paying for the depreciation, which is quite significant. New cars depreciate quite a bit in the first 3 years, but that's what makes it viable. And there's been a huge boom in this, also in America, the same thing. So we've seen this huge boom in the quality car sales. It's going to come to an end, unfortunately, for various reasons, but I don't want to discuss the car market in any detail. But these are very popular, and they're only possible, really, because of these low nominal interest rates and low real interest rates as well. So that's one effect, and a lot of people the financial press have been writing about this as if it's a bit like a bubble, like the housing bubble that we saw before the previous one, but it certainly might well lead to a crash in the. It's not really sustainable for the car industry. The reason it's not sustainable is, of course, because today's new cars become tomorrow's second-hand cars, and that. In 2008-9, there was a big reduction in the sale of new cars, which meant that there weren't so many second-hand cars floating around in subsequent years. But because there's been quite high sales of cars until recently, it means there are a lot of second-hand cars. And so what you'll see is that the new car market will sort of dry up a bit. And so the car companies are heading for quite a rough time in the future, even if interest rates, even leaving out the fact that interest rates are going to rise. So if interest rates were 5%, then your interest payments on 40 grand would be a lot more. So that's at interest rates of 5%, the interest element of your BMW loan would be £170 a month, not £35 a month. It would be significantly making the whole thing much more expensive. So that's it. That's cars. The second thing is the securitisation of ground rents. This again has been something that's been in the press. I've got it from the Guardian there. Leasehold houses and the ground rent scandal. So I think the politicians are doing something about this. But essentially, there are two types of properties. There's a freehold, where you own the land, and there's leasehold, where you own the building, but you rent the land. And typically, houses, normally, when you have a house, it's normally freehold. There are exceptions, like in London, because the Duke of Westminster owns the whole of London, so there are leasehold houses. But normally, freehold houses are sold freehold. It's flats which are leasehold, because obviously there's communal grounds. But recently, house companies like Wimper Taylor and all those guys started selling houses as leaseholds. Now, why is that? Well, if you're an economist, this is quite simple. So ground rents are typically quite small, £200, £300, £400 a year. We're talking something like that. So if you look at the present value of this, it's £200 per year going off into the distant future. The present values of these are given by a very simple formula. V is equal to ground rent divided by R. So in normal times, R is the net interest rate. So if R was 5%, okay, a ground rent of £200 per year will be worth £4,000. So the value of selling that off, securitizing it, will be about £4,000. Yeah, it's quite a bit, but it's not much. But if interest rates are low, it's much more. So a 1% interest rate, that £200 becomes £20,000. 0.5%, it becomes even more. I can't quite work it out, but you know what I mean. So suddenly these ground rents became worth quite big, substantial amounts of money. So if you're building a house that's worth £200,000, the ground rent could be worth 10% of that value. So what they were doing was they were selling their houses as leasehold, and then they were securitizing. They were selling to financial companies the value of the ground rent, and they were getting the cash now. Very nice, thank you. So that's why this thing came about. Again, it's a feature of this age of financial repression and of low interest rates. Small flows of money become worth a lot, and that's what you do. Why has it been a scandal? Well, of course, if you have a leasehold, it's not as good as having a freehold. For example, if you want to do any changes to your house or anything, you have to ask the leaseholder's permission. Now, if your leaseholder is a financial company, the financial company isn't going to say, yes, you can do it for free. They're going to say, you have to give me some money if you want to do that. So the fact that the leaseholders were making it difficult, charging people money for doing extensions and so on, and that's why people got very unhappy about it. And it's become a political scandal, and I think there's going to be some legislation going to go through to do something about it. And the practices got a lot of bad press for the building companies involved. Okay, so that's it. So the ground rents have become worth a lot, and it's given incentive to developers to do it. And the other thing is the death of defined benefit pension schemes, the fall in annuity rates. So the cost. What's the cost of fund? If you have a future benefit that's promised, so that your employer has promised to pay you some money in the future when you retire, for example, if you want to pay somebody £1,000 a year, then you need an amount. Again, we can use this similar thing. So if you've got a future flow of £1,000 a year to pay to various people who will be retired, then the current value of that is £1,000 over R. So how much do you need to have now, if you like, to cover that? Well, if the rate of interest is 5%, again, 20,000 quid. That is £20,000 invested will give you a flow of 1,000. But if it's only 1% interest rate, you need to have £100,000. So the cost of promising people to pay people pensions has gone up, and they become much more expensive. And you may have noticed, some of you, if you've been wandering around here recently, you'll see people with funny yellow things wandering around, singing stuff and making funny noises. So that's a strike there. But more generally, you can see there's been a fall in what's called annuity payments. These are things, if you have a pension pot and you retire at the age 65 or whatever time you retire, suppose you've got £100,000, how much money does that £100,000 give you? Well, here's the chart for a £100,000 fund for somebody aged 65, not sure whether it's male or female, and it's a single person, so you don't, if you die, then your spouse or partner or whatever doesn't get anything. So, but this is a measure, if you like, of what you might have. So, if we go back in time, in 2007, you've got nearly £8,000 per month with your annuity. So, for example, if you had £200,000 pension pot at the end, which is quite a reasonable pension pot to have, it would have given you £16,000 a year. £500,000 bigger pension pot, that would give you £40,000 a year. Now that's really fallen quite significantly. So if we look here at the trough, around about June 2016, it was only £5,000. So £100,000 would give you £5,000 a year. Not very much, is it? Even £500,000 would only give you £25,000 a year. So so the value of these annuities has just plunged for that reason. Now, it's going up again. We'll talk about that a little bit. That's because people are expecting interest rates to rise, and so the annuity rates are recovering, but they're still a lot lower than what they were in the past. So we'll have a do you want to continue now or do you want to break? About quarter of an hour, 20 minutes left. What do you want to do? Carry on? Yeah, you okay with that? Okay, so I'll just talk a little bit about quantitative easing. Where does all this fit into it? Because this is another part of the whole thing. I mean, the Bank of England's purchased a lot of government debt. And you can see this here from the diagram. You've probably seen this in various ways. The red line, so in January 2009, I think it was, it bought over £150 billion of government debt, and it's increased that over time. And it's currently at over £400 billion that's held by the Bank of England. In fact, it's strictly speaking, it's not the Bank of England. The Bank of England does it through something that was set up called the Asset Purchase Facility. But since Andrew Haldane, who's now the chief economist, the Bank of England is in charge of the Asset Purchase Facility. It's basically just a front for the Bank of England, so we won't go into that detail. And this is very big. It's 20% of GDP, so it's very big, 20% of GDP, and over a quarter of our national debt. So remember, our national debt's nearly 100%. That's why these figures aren't too big. And in fact, we can actually just look at the size of it. What I've done here is I've looked at the size of quantitative easing. What are these things? The bank has a balance sheet. So here it's assets, the things, the treasury bonds. I'm using American terminology here, but anyway. And this is the reserves held by banks at the commercial banks at the Bank of England. We'll come back to that in a second. So down here, the purple line is the QE. This is QE. This is all measured in nominal terms here. So the dotted line there is nominal GDP. So there's the Great Recession there. In terms of nominal GDP, it doesn't look that bad. This is M4, so this is the broad money measure. And we can see that broad money was rising. It's been rising faster than GDP. The velocity of circulation has been falling. Currently, this is the level. But it sort of reached a peak shortly after the recession, more or less coinciding with the first injection of QE, but since then it's been fairly stable. And the gap between the green line and the blue line, that's the size of QE, the impact of QE, if you like, on the money supplies, approximately. So that's roughly gives you an idea of the relative size of it. So QE is quite big relative to both GDP, government debt, and so on. So it's quite a massive thing. Why did governments do it? What was the purpose of QE? Well, you can think really of the Bank of England's policy rate, the 0.5%, is a short-run interest rate. However, they wanted to reduce long-run interest rates. And here we have a 20-year gilt yield, government gilt, in nominal terms. And they wanted to lower this. In fact, most government debt the average age of government debt is about 19 years. So the government, most of government debts when they issue it is in terms of these 20-year gilts. And they wanted to lower these interest rates. Now, if you look at the timing here, the interest rate here is 0.5% on government policy in 2009, but the 20-year gilt rate was a lot higher. It's over 4%. Why is that? Well, obviously, the gilt yield reflects what's going on, what people expect to happen over the next 20 years, which is 4%, whereas the policy rate really just represents the cost of short-term liquidity. Short-term. And they wanted to lower the interest rate on gilts. How do you lower interest rates on gilts? Well, you raise the price of the bonds. You raise the price of the bonds. How do you do that? You raise the price of the bonds by buying more of them. So it's as straightforward as that. So it's like a direct way, if you like, of lifting up the price of government bonds. And the way they did that was by buying it. How did they buy it? Well, they did it by creating money. So essentially what they do is they create money electronically. That's the phrase used in the Bank of England publications. They then use that to buy the assets, the bonds from the private sector, or indeed directly from the Treasury. But effectively, it's best to look at it in terms of they buy it from the private sector, because even if they buy it directly from the Treasury, effectively they're taking away one bond, which means that one bond less is sold to the private sector. So when you think about it conceptually, you should think of it of them as buying it from the private sector. Now there are two definitions of money. One is the broad money, N4, which you've talked about here, which is basically equal to all bank deposits, broadly defined, plus cash, notes and coins. It doesn't include the reserves of the private banks at the Bank of England. Now this is where the reserves come important now. So, and there's M0, which is a narrow money definition. It's not actually published anymore by the Bank of England. They stopped doing it 10 years ago or so. But it used to be published, which is cash and notes and coins plus central bank reserves. It's a long story why they don't publish it. Basically, the Bank of England doesn't believe it can control the money supply anymore. But anyway, that's another story. QE. So what QE does is it boosts, in terms of the money supply, it does two things. Firstly, it boosts or creates central bank reserves, and it increases bank deposits. And to understand that, I've written out in full there, but essentially, when the government buys a security, a government bond, from a private sector, a firm, household, pension fund or whatever, the money goes into the bank account of the private bank account of the firm. What happens then, of course, is you have this thing called interbank clearing. At the end of the day, banks in the overnight market, they sort of clear all the funds, so they work out who's paid what to bit, who's paid what to who, and at the end of the day, HSBC says, it owes Lloyds TSB or whatever, £5 million. How is that settled between them? Well, essentially, they both have reserves at the Bank of England, and some of those reserves move. One of them moves from one bank to the other. So if Lloyds owes it to to whoever it was, then those central banks' reserves move within the Bank of England. So that's more or less how it happens. But what happens if the Bank of England's buying something? Well, essentially then, the electronically created money essentially gets put in the bank, gets credited to the bank of the people who they bought the bond from. So if the firm banks with Lloyds TSB, then the money that's being created will be given to the bank of that firm, Lloyds TSB. So that's roughly how it happens. So by creating money, what they do is they create bank reserves. But of course, the firm that they bought the bond from will also have an asset in the term of a bank deposit. So you simultaneously create two things when you buy a bond from the private sector. You create a credit in the bank of the private sector, a credit in the bank in the sense that the bank, the deposit equal to the value of the bond because the person puts the money in the bank, and you also create a corresponding, that's a liability for the bank, the private bank, but you create a corresponding asset in the form of a bank reserve, a reserve at the central bank. And that's what happens. So that's why the process of buying bonds does increase the money supply in an equal amount to the what you've actually purchased. And you can see this in a sense in that diagram that we had here. This is the blue line, central bank reserves, which more or less have gone up almost the same as the QE. In fact, this diagram is a little bit misleading because along here this should actually be positive, so that the lines will be actually very, very close to each other. There are some leakages. For example, not all people you're buying bonds from might be British. About 30% of British national debt is held by foreigners. So in a sense, the effect of the QE might be felt in terms of the foreign exchange reserves may change. So there are some. The reality is a little bit more complicated than the simple story I told you. But the effect of QE is to increase bank reserves. But in fact, it hasn't really had a huge effect. We can see the first round of QE. If we look at this figure, you can see there's the big increase in QE there. And you can see a big increase in the money supply at the same time, M4. But since then, it hasn't really had much of an effect, even though there have been periods when it's jumped up quite a bit. So there are other factors at work here, and that's basically the lending behaviour of banks. So you've probably forgotten it now, but when we did CEI, I showed you a flow of funds equation. The change in M4 is equal to the government deficit plus bank lending, net new bank lending, minus bonds. Effectively, the change in bank lending has been very muted. Banks haven't been lending much. And because banks haven't been lending much, that's meant that QE hasn't led to an explosion in the money supply. Because if you think back to the money multiplier, now nobody believes necessarily in a mechanical money multiplier. Every time you banks owe is bank lending is 10 times what their bank reserves are, or something like that. That's really just an argument. But the thing is that typically you've created a huge new asset for banks. It's equivalent to cash. It's reserves at the Bank of England. It's even better than cash because it pays you interest. The Bank of England started paying interest in 2009, so it's even better than cash. You don't have to pay to keep it anywhere. It's all there, so it's even better than cash actually, reserves at the Bank of England. But you can use those as an asset on which to base your loans. But banks aren't doing that. Banks are not doing that. Basically, despite this huge increase in the if you like the monetary base, central bank reserves, banks haven't responded to that by lending lots of money for various reasons. Maybe there hasn't been a huge demand for borrowing money because of the weak economy or whatever. But if we look at the growth in the money supply, we can see that really since this peak here, that's equivalent to the level. The previous diagram was a level. This is the growth, the annual growth of rates of M4 in the UK, and you can see it up to the until to 2009. It was growing quite rapidly. This is the QE effect. So the growth rate had started falling off. That's the growth rate had started falling off. It was still increasing. Then you've got the big whack of QE there, which meant there was temporarily a very big increase. But it's really come down a lot. And in recent years, it's hardly been growing at all. So it's hardly been growing at all, and that's the growth rate, and that's reflected in this figure here. That's the green line. It's hardly been growing at all there, and indeed it had some negative bits as well in this period. So the money supply hasn't exploded, and that's a very important. This has been the same in the US and in the Eurozone as well, that the money supply hasn't gone off. So, but the problem is, of course, it could do. So, in a sense, you've got a QE time bomb here. That the private banking system has huge assets in the form of their reserves at the Bank of England, and they can start lending a lot very quickly. Now, this is something that the Bank of England hasn't really talked about or even recognised the problem, and they need to do that. Why? Because they need to put in place a strategy to prevent it. So at least need to say, well, if banks suddenly start lending loads of money, this is what we're going to do. And we're not going to let it get out of hand. Why do they need to do that? Because otherwise inflation will take off. I'm not a monetarist, I'm a Keynesian, but certainly if you the economy can only grow at 2 or 3% a year, maybe max. So if money starts growing at a really rapid rate, it's very highly likely that you're going to get quite a lot of inflation there, and that can have some bad effects. So the Bank of England really needs, I think, to say something about this, which they don't. I have my own ideas here. I just think they should have a money supply, not target but ceiling. In a sense, they should say, well, we're not going to let the money supply increase by more than, say, 10% a year. And they can stop that simply by selling. They've got all these bonds which they have in the through QE. They can simply sell them off when monetary growth becomes excessive. But that's not what they're doing. So what are they going to do about unwinding QE? When QE was introduced, it was seen as very temporary. It was only going to last a year or two, and it's been here for 10 years. So again, you can go. This is from 2012. Larry Elliott, he's a good guy. You get the same thing in a Telegraph, though. Quantitative easing. It was seen as a quick fix, but now the world economy depends upon it. They were writing about that in 2012, and it's still here. In America, they've just started unwinding QE. They just started it just before December. So they've only just started doing it in America, and they haven't done it at all, unwinding it at all in the UK. And they haven't really announced any sort of policy. But we do know a little bit about how they'll unwind things. Typically, central banks copy from each other, and the US has been doing it now, and it wrote about how it was going to do it. So it's been a bit more open, the US Fed, than the Bank of England on these matters. How to unwind? Well, it's a two sort of stage process. Firstly, you raise interest rates, and that's essentially what the US has been doing, the Fed's been doing. So its interest rates were very low, like in the UK, but they've raised it gradually to, it's now 1.5%. It was last raised in December, probably be raised again. Where is it going to end up? Well, that depends what your view is of the equilibrium real interest rate is. Because the nominal rate that you're going to end up with is like the equilibrium real rate plus inflation, your inflation target. Well, we know what the inflation target is. It's 2%. So that if you think that the real rate is 1%, the nominal rates will get back to 3%. This is the policy rate I'm talking about here. If the real rate is 2%, it'll be target plus 2%, which is 4%. America doesn't formally have an inflation target, but it's more or less the same arithmetic. And I think that's roughly what people think is going to happen to US interest rates. They'll rise to 3 or 4%. There is a view, why only 3%? That's a lot lower historically. Well, the reason is that there's this argument called secular stagnation, which says that real interest rates are falling. It's a change in the way the world works for various reasons. I'm personally a bit sceptical about that, but it's certainly having interest rates at 3% when inflation is 2% is a lot better than having interest rates at 0.5% when inflation is 2 or 3%. So it's certainly going to go above the inflation target. So we're looking at interest rates of 3, 4, maybe even 5%. So that's what's going to happen. And they've only just started, here's the thing, they've only just started rising it up to, we're looking from 1992 to 2000 there, so this is 5% here. So normally the interest rates have been below 5%, and they're rising up to that level. So that's what the US is doing. It's very gradual. Why is it very gradual? They don't want to shock the markets. They're worried that if you raise interest rates too quickly, the sky will fall in. You've all heard about Chicken Licken and the fairy story about that. Well, they're a bit worried about that if they raise prices, interest rates too rapidly, markets will react to it quite dramatically, and lots of prices will fall, asset prices will fall, equity, house prices, all that sort of stuff. It hasn't happened in America yet. Equity's booming at the moment. Well, it was booming. Maybe with Facebook, Cambridge Analytica, maybe things are going to change. But it hasn't up till now had a dramatic effect. And if stock markets do crash, it won't be due to interest rates. It'll be due to other things, I suspect. So that's it. So in Britain, we haven't really started doing that. They reversed the 0.2. They reversed the cuts, the post-Brexit cut. So it's back at 0.5%, and I think people are expecting interest rates to rise, but it'll be gradual, and it'll do it. We haven't started to unwind QE yet, and I get from listening to when occasionally we have this Bank of England roundtable, you go along and hear what some of these guys are saying, and I suspect that they're not going to start unwinding QE anytime in the near future, and it'll be a slow process. It'll probably involve a loss in the sense that they've been buying these bonds when the prices were high, i.e. the interest rates were low, and they're going to sell them when interest rates are higher. So it's like QE is a policy of buying expensive, selling cheap, and I think most of you should know by now that's not a very sensible strategy, and they'll probably end up losing some money, which will cost a little bit of taxpayer, but maybe it was worth it, who knows. So, as I say, my own suggestion is that they should have a money supply target, a ceiling if you like, at which that would trigger unwinding QE. As bank lending picks up, sell bonds to stop the money supply from exploding. It provides an answer to the QE time bomb and prevents markets being destabilised if there is a really rapid increase in the money supply. It did actually happen. There was a couple of months back in, I think it was 2016, when the money supply really took off quite dramatically. It was growing at an annualised rate of 16 to 20% for a couple of months. I mean, it died down after that, but it could just suddenly explode, and they need to have an answer as what they're going to do that. My own view is that really interest rates should have been raised quite a long time ago, at least to keep the real interest rate being non-negative. So the whole phase of financial repression that we've had since Brexit seems to be a ridiculous thing. And there are a lot of other people, some people agree with me. Andrew Sentence, who used to be on the MPC, He's argued about it for a while, and Kate Barker and others, but it doesn't seem to be the majority view, unfortunately. So why is this? Well, this isn't on your notes. Well, I've got a simple theory about why it is, because there's one group of people who really benefit from having these low interest rates. That's investment banks. Investment banks love low interest rates because they make money by having leveraged acquisitions. So they can borrow lots of money at very cheap rates to make their investments and do things. Now, what's happened to these are all people who are on the Monetary Policy Committee now. So in the old days, you had Mervyn King. He was a professor at the LSE. You had the Deputy Governor was Charlie B. He was also a professor at the LSE. Most of typically you'd have one economist from the CBI. You'd have an economist from the representing unions or something, and the other guys would be academics like Martin Wheel and so on and so forth. But that all changed. So Mark Carney, okay, well he came from the Bank of Canada, but he used to be in Goldman Sachs. He's the governor. Ben Broadbent, who's the deputy governor, and a very good pianist, by the way. He almost became a pianist rather than an investment banker. He came straight from Goldman Sachs. So he was working Goldman Sachs, then he got a job as a deputy governor of the Bank of England. Just recently appointed as a guy with an unpronounceable name. I think he's a Flemish, a Belgian, Flemish, Dutch-speaking Belgian. Gerten Vlaer. He used to work in a hedge fund manager. He was a partner in a hedge fund. I mean, he's got a PhD from the LSE as well, but he was a partner in a hedge fund. Michael Saunders, Citibank. He's a Citibank economist. So you now have a situation where the Bank of England Monetary Policy Committee is basically, you've got the governor and a deputy governor from Goldman Sachs, which is an investment bank, and members. Citibank is one of the biggest banks in Wall Street, an American bank. It's based in London as well, and from a hedge fund. Now, I don't think if you'd have said, in 2009, in 10 years' time, the Monetary Policy Committee would be run by hedge fund managers and people from Goldman Sachs, people would never have believed it. But now it's true, it's all happened. And so I think what's happened is that the Monetary Policy Committee has been sort of taken over effectively by the city. In economics, we have a name for this. It's called regulatory capture. Often when you regulate an industry, the industry takes over the regulator. Regulatory capture. And I think that was because they got the city got a little bit scared in 2009. They were worried that Mervyn King was a bit too independent, and for a while he didn't cough up the money, give them the money. He talked about moral hazard. You're probably a bit too young to remember it, but anyway, but they've done it. And certainly George Osborne was a key factor, the Chancellor of the Exchequer, because he's ultimately responsible for who gets appointed here. And he basically wanted a shift away from academics and independent people to people from the city. And indeed, that's where he works now. He works for the biggest international, is it Blackwater, the International Investment Fund. They pay him, I think it's £600,000 for a day a week. So he's sort of he's quite clear where his priorities lie in life. So that's what's happened. So that's it. But for some reason, it's never reported. I don't know why. Okay, so that's it. So we'll finish there. There'll be one more revision lecture, and you've got your classes all sorted out. So good luck.